Everybody, welcome back to Liquid Lunch. Super excited to be back this week. We have our special guest, Jamie Coutts from RealVision, and we also have Julio Moreno again with our market weekly reports. But we want to welcome all you guys to Liquid Lunch. It's powered by CryptoQuant, the leader in on-chain data analytics that is helping adopt crypto worldwide. And so we can see the massive disruption crypto is having in the traditional markets. And we're here to cover it. We're here to give you the alpha. We're here to stay on top of all the new and breaking things. And so, Julio, hey, by the way, Jamie, we're not going to hold that you don't have your Hawaiian shirt against you. We know you're from Australia. It's okay. Next time, though, we're going to expect a Hawaiian shirt. Okay, Jamie?
Yeah, look, sorry to disappoint. In Australia in winter, we usually rugged up, so I've got a little bit of season envy going on right now. But duly noted, Garrett. For next
Duly
time.
noted. All right. Well, we appreciate you being here, sir. And first, we'll get to the report, the weekly report that Julio does. Julio, congrats. You kind of put this report together that went viral, my friend. So why don't we go ahead and tell everybody about what you found this week?
Yeah, thank you, Garrett. Yeah, this week's report was about Ethereum, and we call it the death of ultrasound money. And we are analyzing, or we analyzed the effect that the recent upgrade, the DENCON upgrade, had on the supply of Ethereum and the growth of the supply of Ethereum. So just to give some context, the supply of Ethereum has been decreasing, the total supply, because of the fee burn mechanism. So when transaction fees are high, those get burned, right? Part of those get burned. And so the net effect was that the supply of Ethereum was decreasing. So that was, I'd say, correct until this recent upgrade, the Dencon upgrade. And so we analyzed that, like what happened after that upgrade to the supply of Ethereum. Let me just show you the first chart here. This is the supply of Ethereum, the total supply, right, in this purple line. As you can see, since the merge, since Ethereum switched to a proof of stake consensus mechanism, this has been trending downwards, right? And a lot of that has to do with lower rewards for validators, but as they switch to proof of stake, but also because Ethereum burns part of the transaction fees, right? So when there was higher transaction fees because higher activity on the network, and you can see that on the pink area. This is the amount of fees that get burned, right? So there was a spike, typically a spike on the fees being burned, and of course the supply declining. So this gave birth to the let's say the narrative or the meme of Ethereum being ultrasound money, right? Because the supply was not only deflationary, it was deflationary, right? And lower than Bitcoin. So that was kind of the narrative for Ethereum, and you can see that since the merge, it was the case that the supply was declining, right? We can see this in this chart. Here we can also see it like the relationship between the fees being burned, right, and then the net supply declining. The new supply being negative, right? And so this was the case, right, up until the Dencon upgrade, which happened last March. And then, so we analyzed, like, okay, what happened since this upgrade? So this upgrade is basically makes Ethereum more efficient in processing transactions and also in storing data. So it makes like more amount of data to be available to store and also to process transactions. So you can process more transactions and also in a more efficient way. So that turns into lower transaction fees, right? And here we can see that the blue line is the total transactions on the Ethereum network, right? And so before the Dencon upgrade, we saw a spike in activity in total transactions, and of course fees. The median transaction fee also spiking, right? So that's the relationship there. But after Dencun, because now the transaction processing is more efficient, we still see like high activity, but the transaction fee, the fees per transaction have dropped tremendously. So that was the intention of this upgrade, right? To make it transactions being cheaper, and so fees will be lower, right? And so that really happened, right? So that was what really happened. Now, because of this has another effect on supply, and more specifically in the fees that get burned, right? So after Denkun, even if with high transaction activity, we get lower fees being burned, right? That was not the case before. We had high activity, high fees, and and as a result, a lot of fees getting burned, right? But after this upgrade, this is not the case anymore. We have high activity, we have but we have low fees, and so the result is low fees being burned, and that has an effect on the total supply of Ethereum now increasing again, right? And so it's not deflationary anymore. That's the, let's say that the bottom line of our analysis was, okay, after this upgrade, because there's less fees being burned, even if we have high activity on the network, then the total supply is not decreasing anymore. It has started to increase again. And we think that it will hardly be deflationary again because of the relationship has switched from network activity and transaction fees. So you can see this in this chart. For example, this is total transactions, right? And this is the median transaction fee. So before this upgrade, this was the relationship: higher activity, higher transaction fees, and as a result, higher fees being burned, right? But after this recent Denkun upgrade, that relationship is totally, it's not no longer valid. So you have high activity, but you have low transaction fees, right? And you can see this the same, but for the fees being burned. Like after the Denkun, we will no longer have enough fees being burned to keep Ethereum deflationary. So that's what we found as a result of this upgrade, and we think that it's going to be really hard for Ethereum to be deflationary again, because you will need like much more activity on the network, like 3 to 4 times more of what we have today to make up for those fees that are not being burned, right? And
Yeah.
so the result is like there was lower and lower supply, right, each day, but now we are seeing supply increasing again. So as a result of this, and so this is what we published last week, and the finding is that, like, okay, maybe this narrative of the ultrasound money is not not valid anymore, right?
So it looks like Ethereum is making more changes to their monetary policy than the Federal Reserve. What's going on there, Julio?
Yeah, I mean, I don't. I mean, certainly the upgrade was a success in the way, because the intended consequence was cheaper transactions, right? And being more scalable, and that was the case. But I don't know if the developers maybe did see or not didn't see this coming, right? Like, okay, but how about the supply, right? We're gonna affect the supply growth if we burn less fees, right? So I think that it's depends on what you want for the network, right? Do you want to be like a competitor for or try to compete with Bitcoin on the narrative of being a sound money, right, and having
Yeah.
a cap supply, or do you need to compete on cheap transactions and more scalability with the other network, right? Because there's a lot of competition for smart contract networks, right? So it depends on what do you want, right? I hardly see, like, I see it like you can hardly have like both for the case of smart contract networks.
Yeah, and with the looming ETF approvals, right, sitting with the SEC, we have yet to determine if they are going to label Ethereum as a security. And so this probably doesn't help their cause because a small group of people, right, are making the consensus change on these upgrades, right? It's not like Bitcoin where the proof of work controls the consensus protocol, right, to a degree. This is a small group of people that are controlling this. Jamie, any thoughts on that? What do you think is the it's going to happen with the SEC and this being labeled a security?
Yeah, look, I mean, on that front, it's possible, but I think the tides are turning. So we have to look through the next 12 months and look at what are going to be the outcomes of the next election. I think we'll see a lot of change within the regulators, and I think that the incoming administration, whoever that is now looking at an electorate that is very much mindful of what is happening with crypto policy. So whether it happens this year or not, I'm not too worried. But I think eventually, it's really a generational issue, right? So you've got a certain element of the representatives in Congress, in the Senate, that just aren't, are of a completely different mindset, and also very much tied to the vested interests of the banking industry. And if America actually understands really how to dig themselves out of this massive debt hole, they need productivity. And so I think that's starting to resonate with the younger representatives and the need for actually fostering technology, including blockchain and others. So yeah, I mean, I can't profess to know in the next 12 months, but I think ultimately it swings in Ethereum's favor and in the industry's favor. But I'd just like to say, Julio, that's a really great report. I was talking about what was going to happen from these upgrades, all the way last year. And at that time, we didn't have the data. Now we've got the data, you've run the regressions, and you can see that analysis much more clearly. And I think it's quite compelling. But I'd also just say that, I mean, you made this point, but I'll just reiterate it. These two assets, Bitcoin and Ethereum, are in completely different design spaces. I mean, Bitcoin's only competitor is fiat. Ethereum's competitor is not Bitcoin, in my mind. It is all the other smart contract platforms. And so the decisions that as Garrett said, the small group of programmers and developers, that's maybe debatable, but I get the point. It is a different consensus mechanism. Decisions get made in a much more different fashion. But this protocol is really, I think, competing in that smart contract platform and space. And in order to do that, you're going to have to decrease fees, and you're going to have to increase the utility by decreasing friction. Transaction fees is one of it. So as much as it is, if depending on how you value the asset, it is a negative from if you're looking at it through the monetary lens. Ultimately, I think in terms of the utility factor for Ethereum competing for Web3 applications, this is a positive move ultimately. So, I always keep those two very separate in my mind, and especially when it comes to asset allocation.
Yeah, we're seeing
Yeah,
kind of take advantage of the lower fee narrative. And so it looks like Ethereum's definitely trying to be competitive. One more point I wanted to bring up is if you have not seen James O'Keefe, he did have a whistleblower, Stephen Narioff, who was an original developer for the Ethereum Foundation, who disagreed with some of the protocols. And so there's a whole whistleblower report when they were looking for public comments with the ETF approval. And so I recommend you all go look at what James O'Keefe uncovered with Stephen. It's pretty interesting. But sorry to cut you off there, Julio. What were you going to say?
yeah, just adding to what Jamie said, and I totally agree. Like, I got actually this question after I published the report, what what's the bottom line for investors, right? After this, and I agree with you. It depends on your thesis, right? Your investment thesis for Ethereum. Like, if you were getting exposure to Ethereum under the thesis of, oh, this is ultrasound money, and maybe that's not the case, right? And you should like reconsider that especially after this upgrade. But if your thesis, well, no, this is a smart platform contract, the biggest one, it's a great platform for developing, decentralized finance applications and all that. Well, this upgrade really, proves that thesis, right? Like, because now it's more scalable, now it's cheaper to transact, so you can build more on that, right? So it depends, on your thesis, but we wanted to just to make, clear that the other thesis, like the monetary thesis, maybe is not as strong as maybe when it was deflationary, right?
Yeah, no, all great commentary. And so we wanted to absolutely get into the next section of this, which is, kind of talking to Jamie about, first of all, kind of his crypto journey, how he got involved in Bitcoin. And so before we go to that, let me just share my screen real quick. I want everybody to check out RealVision Crypto. Okay, so if you guys want to go check this out, you can go to realvision.com/RV crypto. And so check out Jamie, check out what he's doing over there. And so Jamie, tell us a little bit about how you got introduced to Bitcoin and when the light bulb kind of went off.
2013, Cyprus, Zero Hedge was running articles talking about this digital money, Bitcoin. Bitcoin was rallying as the bail-ins were happening with Cypriot depositors. And that was the first time that I actually had heard about it. But like many people, I'm a pretty slow learner, and I have to make as many mistakes as possible on my journey through life. So I ignored it. I traded it because I have a background, some buy side, sell side, and very strong in sort of like a technical analysis systems. So I traded it throughout the 16-17 bull market, but I didn't really do the work. I didn't understand it. I didn't fully appreciate what it really meant. And it really, through the bear market of 18-19 is when I really dug deep. At the time, I was working for Bloomberg, and I really started to pound the table there, because at that time, Bloomberg really wasn't doing anything in that space. No one really understood it. So I was sort of put in charge of the strategy around digital assets in Asia, and built the relationships with clients and started developing products. And that sort of led me into a research role with Bloomberg Intelligence, where I was the crypto market strategist for a couple of years before moving over to RealVision to work with Raoul Pal. But the journey is, it was a long one, and unfortunately not as fast as it would have liked to have been. But it's been extremely rewarding. It's been the best thing I've done in my career. I've been in the markets for 25 years now. Can't believe I'm saying that. And really, it's the reinvigoration and the intellectual stimulus you get from this entire space has sort of reinvigorated my interest in, in finance again. And it's been a great journey.
Awesome. And so you built the Bloomberg Intelligence product that revolves around crypto. So that's awesome, right? Helping mass adoption, helping get it to the hands of everyone. And so do you want to tell us a little bit about RealVision and what you guys do there and what people can expect when they check out your product and your website there?
Well, most people would probably have heard of Raoul Pal. So I've been speaking to Raoul for the last couple of years, and we've done a lot of sort of collaboration on developing models for crypto assets, for digital assets. And so I joined him to basically run the crypto product, the crypto research product. He very much focuses on macro, but has a very strong crypto tilt. So within the RealVision platform, which I've been a subscriber to since, I think I was one of the original subscribers in 2013. And the reason why I've been a subscriber for so long is that long form content at that time was pretty scarce. I was working at Bloomberg, and if anyone watches Bloomberg or CNBC, it's fast food for finance people. It's low nutritional value, not very deep, sometimes stupefying. And so content which is actually digging a lot deeper in long form interviews was something that I was very attracted to. And I use that, a lot of the content and research in my process over the years to get to where I am today. So I joined Raoul to really flesh out a lot of the work that I'd done at Bloomberg, where I was developing valuation models for crypto assets, and also marrying it with technical sentiment and macro. And so at the RealVision, on the RealVision platform, what you get as a subscriber is long form content from myself and reports, and from other contributors in the space, including the macro stuff that Raoul does, long form interviews, community events. It's global. I have a community down here in Sydney. We're doing events all around the world all the time. There's Discord channels and all the rest of it. So there's something there for everyone. And the current subscription package is two-tiered. So you've got a very high level one, Crypto Pro, and a base level one now. which is what that link that I think you're showing will take them to.
Awesome. Awesome. Love to hear all that. And, appreciate the work you guys are doing in that realm. And so go check it out, guys. Go check out realvision.com. So let's get into some of the liquidity supply dynamics of what's going on with Bitcoin. As you know, right, the halving just happened. The rewards got cut in half. And so we're seeing miners, right? We're seeing the best of the miners, right, kind of do their thing. And we're seeing some miners kind of fall behind. And so any thoughts on what that's looking like and what you guys are seeing and as far as the miners and the energy and the sustainability aspect right now?
Well, I've done quite a bit of work around the sustainability aspect to Bitcoin mining and what that means geopolitically, and also what it means for this whole climate debate. But I thought maybe I'll just touch on what I'm seeing just in the charts here, Garrett, in the short term, is that you look back in the last cycle, you're pretty much seeing the same pattern play out. There was a surge in miners outperforming Bitcoin, and then in the couple of months preceding that, they all started to underperform as the realization of the supply crunch and what that was going to have on the network at the time. Same thing played out. We had massive outperformance in the miners leading up until really the start of this year. And then they all started to underperform as we led into the halving. And what's interesting is if you look at the 1 month returns of listed miners, there is a real dichotomy amongst the list. There are some that are actually up by 5, 10, some up to 20% over the last month, and others that are negative. So I think this is interesting just from, if you follow sort of relative strength analysis, then I'm starting to see the breakout of certain miners that are in a very strong relative position to the other miners, but also starting to outperform Bitcoin. And what happened in the last cycle after the halving was that you did see some of the miners really excel for a 12-month period after that, outperforming the Bitcoin return of that last cycle. And I think we'll probably see that again. And what adds to that is this. Back then, this was becoming a sort of a narrative or a meme. It's now certainly taken on a whole new life of itself. But basically, excess energy, low-cost energy from sustainable sources are now a larger part of the mix. And also, the efficiency of the miners is just, it's obviously increasing over time. And so this, the other aspect too, I should also mention, is really AI. A lot of these miners are starting to look at diversification of their earnings into data warehouses that provide the services, provide the data warehouse and services for AI compute. And so this sector, whilst it was sort of singularly focused, I think is going to morph into Bitcoin mining / AI, and that gives them just this another lever to the story. But I'll leave it there and let Julio comment, but we can talk about the sustainability stuff, Garrett, because it's a bit of a bugbear for me. I'm not sure if it is for you, but there's tons of really interesting stuff happening about the whole ESG debate in mining.
Yeah, I have a comment, about the miners. I mean, yeah, the outperformance of the miners, it really depends on the price, right? Like on the price of Bitcoin increasing after the halving, and not necessarily increasing right away, right? It takes months. But what do you think would happen, or in a scenario that we don't have like that, really, large increase in price, right? So miners don't get that extra revenue from Bitcoin rallying as it has done in previous cycles. That for me is like a interesting scenario to think about when thinking about miners, right? What do you think happens, or who do you think will sustain their operations on that scenario?
Yeah, so I mean, Julio, you've done this work as well. At least 6 weeks to 12 weeks is usually the time of the last 3 cycles from the halving to when actually price starts to move. You get this real low after the halving. And so then it starts to move. So your point about what if Bitcoin doesn't actually perform, what if we've seen maybe like the top of the cycle, or we see a very, very muted performance in Bitcoin this cycle relative to other cycles. Yeah, I think, I mean, that obviously caps their upside. I mean, this the underlying profit, how they generate income is the spread between price and their cost. So if the price doesn't go up as much, they will not perform or not outperform as much, or at all. But you'll still see this divergence between the list of public miners, ones that are that have just a better cost structure, that are acquiring sites, where there is excess and excess energy, through sources like hydro, which Marathon have been doing in places like Paraguay. So it's really a case of like you have to really pick your miner, but if the Bitcoin price doesn't outperform, it probably won't help that asset until 1 to 2 years down the line, when AI becomes a much more significant part of their earnings, and maybe the cycles for the Bitcoin cycles don't matter as much as they do today.
Yeah, and so back to the sustainability question, we did have a gentleman at Barefoot Mining on last time, and so we talked about sustainability to a degree, right? I mean, Mara just signed a deal with Kenya for capturing flare gas, and so the main argument has been that Bitcoin mining is bad for the environment, right? But as we see, if we look a little bit deeper, peel back the onion, we're noticing that it's much more sustainable than previously, than the media is actually reporting. And you have the Biden administration coming down on the miners, right, with excess taxes based upon, what kind of energy is being used for. And so, yeah, any comments on that, Jamie?
Oh, it's bananas. I mean, again, this is just another policy from a class of representatives that are really at the end of their tenure, and are trying to protect their own vested interests. And it won't stand over the long term. I think the groundswell behind a more fair treatment of crypto, of Bitcoin and crypto, is on its way. But just the data doesn't support it. It's absolutely bananas. So if you look at the percentage of sustainable energy sources used in Bitcoin mining, the best estimates that I've seen, Daniel Batten out of New Zealand, runs a venture capital fund, who's actually building projects on landfills to convert landfill methane into usable energy for Bitcoin mining, which is actually carbon negative. Like, think about that. So about
Jeez.
7% today of Bitcoin mining is being pulled out, or sorry, of the carbon emissions being pulled out of the air. If that trend continues, you're going to see a crossover where there's going to be no footprint from Bitcoin mining. Now, that may be 20 years away, but no other industry is actually sucking carbon out. And if you look at just that breakdown, what I mentioned earlier, 53% of Bitcoin mining comes from sustainable, which includes nuclear, and renewable. So, and that's rising. I mean, it was 30% 3-4 years ago. It's 53%. It's on its way really to 80% in the next sort of couple of years, maybe 5 years. No other industry has that footprint. I mean, that's if you actually believe the whole narrative about climate, which may be controversial, but I don't buy it for 1 second.
Yeah.
But if you're going to play that game, then the data speaks for itself. This industry bootstraps renewable energy projects. If you've got marginal renewable energy projects on your grid, and if they're marginal, what that means is we, as the consumer of retail energy, have to subsidize those, suboptimal energy solutions. So our energy, I mean, in Australia, energy's tripled, and it's tripled at the same time as renewables on our grid have tripled. So causation, it's really clear that this stuff is not the cheap energy that they promise. We're subsidizing it. So if we're going to go down this path, which I think is crazy, bring in Bitcoin miners, bootstrap these renewable projects, subsidize the consumer, and look at really innovative ways to basically suck carbon out, if that's your thing, if that's really the concern here. And landfill is just an obvious one. Like, no one wants to be next to a landfill site breathing in methane. It's extremely toxic. So, it's just, I think that narrative is just falling apart, and it has massive implications for asset allocators. If you're an ESG or sustainable asset manager, no one in that space is really there mentally. But I know that several are reviewing, which means 12 to 18 months processes the day a sustainable fund or an ESG directed fund puts Bitcoin or a miner in their portfolio, I think it's game over for this, anti-mining narrative.
Yeah, agreed. Agreed. And so next we want to kind of talk about the supply dynamics right now. Okay, we've got a supply crunch, right? We've got the halving event, which is reducing the rewards, but the Bitcoin left on exchanges is what, around 1.5 million coins. I don't think it's been this low since maybe what, 2015, 2016. And so we've got, some macro liquidity, indicators. We've got on-chain indicators. Which one's taking precedent, and what do you think of the dynamics? I mean, it still seems like people aren't really trading this asset like they know it's a finite asset. They still seem like, that there's going to be just an abundance of these coins on the exchanges forever, and it's, that is definitely trending downward. And so, yeah, maybe let us know what you guys are thinking over there at RealVision and how to kind of analyze this for people.
Well, I think the marginal driver of everything in Bitcoin is the macro cycle. I mean, Bitcoin was a market response to a failing financial system. It's an anti-debasement currency, but it also has this peer-to-peer transfer network, this network value as well as basically a financial system to move value around the world in a way that doesn't require an intermediary at very low costs. So the macro environment drives the adoption. There's also secular things going on. I mean, we've had waves of technology over the last 30 or 40 years that are building upon each other, and the internet doesn't have a money protocol at the base layer, and so Bitcoin serves that. So you've got technology as a sort of secular trend, which is driving everything. We're all becoming digitalized and using more online services, and we're part of the moving into this world more and more. So there's that aspect. But if it didn't have the properties, if it didn't have the sort of anti-fiat currency properties and the anti-traditional finance properties, the current banking system, it would have a harder time being adopted. So as much as the on-chain data is really great, I get very nerdy and deep in it. And Julio, you do it for a living as well. We both nerd out on this stuff all day long. You can sort of tie yourself up into knots looking at it. Is this metric telling us this thing? And why isn't this one moving the way it did last cycle? As long as we have the backdrop being what it is, debasement of currencies, and this sovereign debt, the sovereign debt spiral, then every day the system does what it naturally is going to do, and it cannot stop. More people come into the system, adopt it, whether that's to use it as a peer-to-peer network or to use it as a store of value.
Okay, awesome. And so in that context, as well as the adoption rate, right, as we're looking at the macro lens of the adoption rate, we are seeing major institutions, right, Wells Fargo, JP Morgan, having exposure to the BlackRock ETF. And so, is that cooling down? It seems to be cooling down a little bit, right? Like, we had a lot of people come into this space. They were buying up a lot of Bitcoin, and now it seems as if that's cooling down a little bit. Are we going to see these institutions allocate a larger, percentage of their funds? Are they kind of cooling off right now? What do you see as this leads to more adoption from the macro point of view?
I mean, it's some of these institutions just take a long time to move. And we're seeing corporates like Square, and there was a corporate in Japan adopt Bitcoin on their balance sheet. There've been all these little pieces of the puzzle sort of fall into place over the last sort of 12 to 18 months. The FASB ruling, even regulatory requirement rulings for banks has changed. Not that it's not punitive, but it's not prohibitive anymore. It's sort of laying the sort of the groundwork. But I mean, we had a massive run up. I think Julio, you could speak to this a little bit better than I can because I can't remember it specifically. But the pre-halving performance of Bitcoin this cycle was, I think, the second best. So
Yeah.
we had a huge run up. And now it's pausing, and it does that after halvings. But yeah.
Yeah, you're right. And we had a all-time high before the halving, which has never happened also before. We saw in Q1 a lot of demand for Bitcoin. of course, from the ETFs, but also we can see on chain that it was also larger than the ETFs. So there's certainly other entities also. But we saw how it started to cool down as we touched the, we pierced the all-time high. As we got the fresh all-time high, it started to slow down, like the demand for Bitcoin, from ETFs, but also from different cohorts that we track, like the whales, right? The addresses that accumulate Bitcoin. All that slowed down a little bit. And I think, I don't know what you think, Jamie, but I think that it was more of a, because we were in an all-time high, and maybe, like there was demand destruction there, right? Because nobody wanted to be buying at all-time highs, right? And also maybe we needed like this correction. What's your thoughts on that?
Yeah, so I mean, there's quite a bit to this, but what I track a lot of the macro factors, and so I have a dashboard which we publish at RealVision, and Raul has his framework as well. Different frameworks, but we kind of arrived at the same conclusion. But since the start of the year, we've had warning signs that the macro picture was worsening. So we had this massive bottom in 2022, and that was really the result of a slowdown in the tightening. Tightening has still continued. Rates are still high. QT is still ongoing, but the rate of change of central bank liquidity withdrawal slowed, and that is always enough to put a bottom in risk assets. Since then, we've had this sort of oscillation between tightening and loosening through all the different macro and liquidity indicators that I follow. And in January, they all started to roll over again. Now, that just happened to be when the ETFs launched. And so pent-up demand came into the market at a time when typically Bitcoin underperforms. Like you just look at the US dollar, very highly correlated to the Bitcoin price. And that's really been stronger over the last sort of 3 to 4 months. So they had this divergence between Bitcoin and really what the macro conditions were telling us. And that was almost entirely due to the ETFs, but I should also layer on derivatives exposure because of the ETFs. And I think that just culminated at a time when, essentially you had geopolitical strife, and it was basically a cooling off period where there was no macro impetus to actually be long a lot of risk assets. Now, I don't believe that Bitcoin should trade in line with, should trade negatively to geopolitical events. It should trade the other way, in my personal view, like gold did when the Israeli Iran situation exploded. And so but that may take a long time. And at the same time, you have to respect what the market tells you. The market doesn't treat it like that. The market sold it off at that time. So there's still a lot of maturation going on. But those macro conditions are still in place. Like the DXY is still at 105, 106. But what have we seen in the last 1 week? BOJ intervention. We've seen the Fed cut QT by 50%. Again, the tightening is decelerating. We're looking like we're going to come out into a liquidity uptick in the second half of this year, and we all know what happens to risk assets in that environment.
Yeah, I was going to touch on that as we, possibly the yen is kind of the canary in the coal mine, right? We see the FX intervention, we see the Fed offering them
the swap line,
right? To basically bail themselves out, right? Maybe afraid that they're going to dump treasuries. And so if they start to lose that peg again, right, is that going to, be that that crisis that we have? We have BRICS coming on board, right? We have these other alternative currencies competing for oil, for energy on a worldwide scale, right? And so, how do you guys view those different topics?
I think they just all feed into a very compelling case for Bitcoin as a monetary alternative. I mean, I appreciate what the BRICS are trying to do. I don't know how well that goes over the long term when you've got varying nations of varying degrees of trust or trustability. So I mean, they're going to start trading in their own currencies for commodities. That's great, but I think that highlights even more the need for a neutral, non-sovereign form of settlement, which countries are just not mentally there yet, like in terms of where they see Bitcoin. But I think we're on that trajectory to reserve asset status, but it's many years away. But the fact that the world is fracturing, I think, will just accentuate the call for something neutral. And maybe it's gold. I mean, gold is being remonetized by the central banks. They are buying it like it's going like never before, or at least multi-decade highs. But central bank gold is central bank money and Bitcoin is people's money. So either way, it plays into Bitcoin's hands.
I like that narrative a lot. So what if they label Ethereum a security, right? Who cares? What's that going to matter in the market dynamics if that does take place?
Well, it changes the regulatory requirements for the intermediaries in terms of how they offer that and trade it. So, there's look, I mean, in Australia, there's no such definition, right? So it doesn't matter to the rest of the world, it only matters to the US, and obviously that has a big implication for the rest of the world. But like I just see that you've got proposals made 4 years ago, 5 years ago from someone like Hester Peirce, who created a sort of a framework for digital assets to navigate this security commodity divide and provide them with a path to either becoming a security or maintaining or becoming something else, something like a decentralized asset. Let's call it that. I think she used different terminology. And so, look, I'm not an expert on securities law in the US, but I think if the trend that I'm seeing is for change ultimately at the regulators, and you've had common sense proposals made by people within the SEC that are still there today, to their credit, have stuck it out. I think something like that happens in the future, and that will be very interesting as an analyst, because if they bring in rules around what is a decentralized asset, what is a centralized asset, or what is a security, then a lot of these protocols may find it tough or may have to completely change consensus mechanisms or the supply schedule or the amount of vesting that the insiders need to do in order to bring it to this threshold or definition of a decentralized asset, which I think is fascinating and ultimately great for the space. Like if you can't get decentralized, then you should be a security or you should have different rules. And it would also clear up a lot of the shenanigans in the space. Like, I'm just sick and tired of what's been happening with vesting schedules, non-transparency, the lack of public ownership of these assets versus the insiders. So ultimately, I think it's all positive.
Yeah, the SEC hasn't really been giving too much clarity. They've kind of been just going after people and not really giving them clear direction on what is acceptable or not. And so we're kind of living through the trial by fire on what they deem, a security or not. And so, obviously more regulations get put into place on those assets, which means, technically, people can't be pushing those assets unless they have certain licenses, right? There's certain requirements to talk about certain assets. And
also,
so,
Garrett, can I just say also from the issuers of the asset, higher thresholds. If you want to issue a token and you're centralized, well, then you have to provide disclosures, reporting like companies do. And I think that's good. Like either you choose that path and get on board, or you decentralize and, release control into the hands of the public. And so that these assets become what they were, originally designed to be.
Right. Good point. Good point. Yeah. What do you guys think of, I guess, digitizing real world assets? I guess maybe layer two, smart contracts. And then this is kind of all one big solution or one big question about layer two. Are you bullish on Bitcoin and ETH layer twos?
Yeah. Well, okay. So I wrote a paper or a report 2 weeks ago on the use of Bitcoin as collateral for smart contract platforms. There's a protocol called Babylon. And so they are basically offering native staking, so staking on the Bitcoin chain. So no transfer of assets, no bridging, no trusted intermediaries, and offering the potential for a yield on Bitcoin by actually securing proof of stake networks, which is a fascinating concept, and obviously will make a lot of people upset at the pure idea of that. But it is an improvement on everything we've seen before in terms of centralized staking. Whether that would be something that I would want to do with my Bitcoin, probably unlikely. But given that there's 10 to 12 billion of wrapped BTC, which is a horrible solution, earning next to no yield in proof of stake chains, this looks like a better alternative. So that's one example of all these L2s. I have not had the time to go through them all, but I'm definitely looking at building up dashboards and analysis around that going forward. But you've also got a different cohort within the Bitcoin community versus proof of stake blockchain. So it's open for debate how successful they would be. From first glance, it sounds like there's too many, given the size or the willingness of Bitcoiners to do anything with their Bitcoin in that space. So I think it'll be ultra competitive. But I'm pretty bullish on the proof of stake ecosystem as a separate asset class. And I don't really have a strong view on the L2s on Ethereum as investments, because there's no value accrual, right? They're centralized at this point. So until they become centralized and they turn on a fee switch, which most people are afraid to do because of what the SEC has done just to Uniswap recently, so they aren't compelling, and they look pretty overvalued on some metrics. But then there's like those other L1s, which I think are taking mind share, and because of the low friction, and the trade-offs that come with that. Like Solana has different trade-offs. It is not Bitcoin. It's not designed to be Bitcoin. But if you want to do fast stuff where you don't need as high security assurances in a Web3 world, Solana is a great network to do it. And there's others. So I think like TLDR, exposure to these smart contract platforms in a really, really dumb fashion, which would just be like a certain allocation across the top ones, kind of makes sense. But the Ethereum L2s, as much as I love them for scaling Ethereum, as an investment, I don't really see the catalyst until they have some sort of value accrual.
Yeah, and so the L2s on Bitcoin, we've got Stacks. You're talking about Babylon. That's a new one I've heard of, haven't heard of. And then you also have Counterparty. Counterparty is one that some of us are kind of bullish on, the L2 smart contract layer that's been around since 2014. So, yeah, I mean, Bitcoin does have smart contracts, right? And so we'll see at the end of the day what takes precedent in this new ecosystem, as Larry Fink is big on tokenization, right? And I think a big setback to that is Bitcoiners are totally against tokenization, right? They are completely against the idea of tokenizing anything. And so they've got this very narrow-minded view of what the future looks like, I think, to some degree, because they don't understand that digitizing, I think, real-world assets is a very positive step for all of us, to prove ownership, right? Prove scarcity and how this kind of, goes to fruition. And so what's going to be the major factor of driving more demand? Is it going to be the Fed easing policy? Is it going to be the dominance loss of the US dollar? Is it going to be, possibly more institutions getting on board? What do you guys see as we've always said Bitcoin is a liquidity chaser. And so is that really kind of the fundamental macro thing that we're looking at, Jamie, or what do you see?
Yeah, I mean, I think liquidity drives everything. So if we get the sort of things that I'm expecting, then that's going to obviously drive demand from everyone, whether it's individuals to institutions, especially now that there is accessibility through ETF wrappers. So I think, yeah, like it's pretty much liquidity. Liquidity drives the sort of marginal buyer into the space. But then if you want to sort of talk about the cohorts within maybe the institutional sort of category, look, we haven't seen it yet, but I believe that nation states are accumulating currently, and these are nation states which have mining operations. So my thesis has been that in the countries where you've got mining operations, mining excess energy, or stabilizing grids, serving some sort of national interest, which is the reason why they invite miners in the first place. So it isn't just because, there isn't, like in a lot of these emerging markets, you have to work with the government, you have to work with the state in order to bring in such a controversial industry, especially one that's, where BIS, the ECB, and every other supernatural organization wants to write total shit posts about all day long. I mean, see how the IMF went after El Salvador for daring to pay back their debt. I mean, this is what a small nation state has to think about when they invite Marathon to actually mine Bitcoin. So where you've got this very close private-public partnership going on, and the nation's savings are usually with a sovereign wealth fund or a sort of pension fund of national significance. This is a hypothesis, so I obviously don't know, but where you've got virgin Bitcoin that are non-KYC, that haven't gone into an exchange, where you've got countries that are sort of at the nexus of the energy the energy market, where they've got excess or they're a strong player, and their allegiances are changing, and the fracturing of the global order. I think that they'd be accumulating Bitcoin. They're just not going to be talking about it until at such a time as it makes sense to talk about it. So you've got that, and then you've got, I guess, the sustainability ESG argument, which is again, a multi-year sort of process. But I think you'll see corporates, Bitwise, the CIO there, Hunter, I think, mentioned that in the future, quarterlies from Bitwise, they will be releasing names of corporates that have accumulated. And so there's probably some surprises there as well.
Yeah, I think we're going into this game theory aspect, and I think we need to probably say that these governments across the world are not as dumb as we think they are to some degree. They are definitely seeing the dollar, right, lose its dominance in some sort of path. They're seeing this administration, the way they treat crypto. And I think some of these countries are seeing a real opportunity, right, to possibly bolster their economy and their own currencies by maybe adopting this new protocol, right? And so there are definitely some surprises, I'm sure, in store. The cat is not out of the bag. We like to joke and say the first central bank that just figures out you just can print money and start buying this stuff kind of wins, right? And that can happen at any point. We don't know when that's going to happen. So it's interesting in how this is playing out. We've got the Middle East, we've got Qatar, we've got a lot of different players out there that could anytime start buying billions of dollars of Bitcoin. We still got the Michael Saylors of the world. And you said that they're repeating, right? You've got Japan with Metaplanet, right? To where they are basically mirroring the strategy of MicroStrategy, right? They're taking out bonds, they're taking out equities, and they're just buying Bitcoin with it as their treasury reserve asset. And we've seen the wonders it's done for MicroStrategy. So I expect that to also increase as companies start to realize the benefits of Bitcoin. I wanted to also point this out again. If you guys want to go check out RealVision Crypto, and you can get an account there, realvision.com/RVCrypto. Check out what Jamie has to say. He's also on Twitter, guys. If you want to check him out on Twitter, you can go to Jamie, that's JAMIE 1 COUTTS. So go ahead and check out what he has to say on these different macro environments, on these different tokens that they're covering. And we're excited to be with you here today, Jamie, and we appreciate your input on this stuff.
Look, I really appreciate everything that CryptoQuant's doing. So it's been a data provider for the last couple of years, and I've loved being able to access all the analytics. So thanks very much for everything you guys have done.
Awesome. Yeah, we appreciate that. And so thanks everybody for hanging out with us at Liquid Lunch, powered by CryptoQuant, the leader in on-chain institutional data analytics. Go check it out, CryptoQuant.com, to get a free account, get set up. We offer APIs on all of your favorite trading assets in the crypto industry. And we will see you next time. So everybody, take care, be well, and we will catch you next time. Bye.